Did you think S&P 500 ETFs are the safest investment for beginners? Well, think again. The biggest investing mistake you might be making is hiding in plain sight. The truth isn't what most people tell you, and playing it safe might not be safe at all. In this video, we will reveal the truth and tell you why S&P 500 ETFs might not be the golden ticket you think they are. From hidden risks to master strategies, we will expose the flaws that could slow down your wealth-building journey as a beginner. Most beginners fall into this hidden trap, and they don't realize it until it's too late. You wouldn't want to miss where the real dangers are hiding, right? So stick around till the end and learn how to not fall for the beginner's trap. You may have heard that the S&P 500 ETF provides exposure to the 500 of the largest US companies and offers diversification. And it's true, they have historically delivered solid long-term returns. However, despite these advantages, they may not be the ideal choice if you are a beginner investor. One of the main reasons is the lack of downside protection. As an investor who has just stepped into the market, I'm sure you seek downside protection. But since these ETFs track the S&P 500 index, they are already fully exposed to market downturns. In bear markets, the S&P 500 might experience significant declines. For instance, if you remember, the 2008 financial crisis was the worst for investors who had invested in the S&P 500 ETF because the index had lost over 50% of its value. It's no secret that as a beginner, you might lack experience in handling market volatility. So, you may panic and sell at a loss, locking in your losses instead of holding for a long-term recovery. During the COVID-19 as well, we saw a sharp decline in the index, which had caused stress for many investors who lacked experience in navigating such volatility. And the main problem is that unlike actively managed funds with bonds and alternative assets, S&P 500 ETFs don't even have a built-in mechanism to hedge against downturns. Overexposure to large-cap stocks. The index is heavily weighted by market capitalization, which means that the largest companies have the greatest influence on its performance. We all know that the Magnificent Seven tech stocks, which includes Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, and Alphabet, make up a significant portion of the index. So as a beginner investor, if you have decided to put your money in an S&P 500 ETF, this means that instead of going for true diversification across different sectors and asset classes, you're primarily investing in a handful of mega companies. And it goes without saying that if these dominant companies underperform, the entire ETF performance suffers. So this can create unnecessary risks for you as a big investor. Many of these large stocks do have high valuations, which means there's lower potential if you are expecting exponential growth compared to small cap or emerging market stocks. Lack of diversification in other asset classes. As we have mentioned already, the S&P 500 does provide diversification across different industries. However, it does not cover other essential asset classes. Large stocks are not the only stocks present in the market. There are other stocks that can give you significant returns. One of the major examples is small cap stocks. Historically, these stocks have outperformed large stocks over the long term, yet they are not present in the S&P 500. There are fixed income securities as well. They provide the maximum stability and counterbalance stock market volatility, which is very crucial for risk management. Another problem is that the S&P 500 only includes US-based companies. This means that as an investor, you might miss out on opportunities in emerging and developed international markets. And we can't forget hard assets like gold, oil, and real estate. These can hedge very well against inflation, yet they are not included in an S&P 500 ETF. The next one is volatile, but digital assets have become an essential component of many diversified portfolios. Legendary investors have suggested beginners to start with digital assets like cryptocurrencies, but they are nowhere to be seen in S&P 500 ETFs. Overvaluation risk. As a beginner, if you invest in an S&P 500 ETF at the wrong time, then you might end up buying into an overvalued market. We know that the S&P 500 has had extended periods where it traded at historically high price to earning ratios. So, investing in an overvalued market can lead to lower future returns and potential losses if valuations revert to the mean. And unlike experienced investors who might use valuation metrics to time their entry points, you as a beginner may not be aware of these risks and might end up buying high, leading to potential disappointment and losses. Some investors who bought at market peaks, like the dot-com bubble or the 2021 post-pandemic rally, have reported to have faced a long recovery period. Lower potential for higher returns. Historically, the S&P 500 has provided annualized returns of around 8 to 10% over the long term, but this is not the highest return potential available to investors. Individual stocks, small cap stocks, sector-specific ETFs, and even hard assets like gold can often provide higher growth potential. So, if you are willing to take on more risk as a beginner, then you should actively research investment so that you can find better opportunities outside of an S&P 500 ETF. Because while an S&P 500 ETF provides steady and reliable returns, it may not be the best choice if you're looking to maximize your early investment gains. If your goal is to maximize your investment gains, then you can go for technology-focused ETFs, high-growth stocks, or even emerging market funds, because they might provide better long-term wealth building opportunities. Relatively lower dividend yields. The average dividend yield of the S&P 500 index is typically between 3% and 5%. So if you've entered the investment market looking for passive incomes from dividends, then be ready to be disappointed, because you may find the S&P 500 ETF a little different than what you were expecting. Compared to the high dividend ETFs, the S&P 500 offers relatively low dividends, and they might not meet your needs if you are an income-focused investor. As a beginner, it's obvious that you'll seek a balance of growth and income, but you might not be able to get that from an S&P 500 ETF. So, it's better if you go for an alternative dividend-focused ETF, or maybe even individual stocks with higher dividend yields. Some sector ETFs, like those that are focused on utilities, or maybe consumer staples, can provide a much better income-generating potential for you. Market timing. Even though the S&P 500 ETFs are mainly designed for long-term investing, as a beginner, you might struggle with market timing. Let's say that a market is at an all-time high. In this case, you might hesitate to invest, fearing a crash. And then, when a market declines, you might panic and sell, missing out on potential recovery. This behavior can lead to buying high and selling low, which is literally the opposite of a sound investment strategy. So, as a beginner, if you have not developed the right mindset, then you might find it difficult to manage your investment in an S&P 500 ETF. High expense ratios. It's true that the S&P 500 ETF has a low expense ratio compared to actively managed funds, but if you compare these expense ratios to constructing a personal portfolio, then they may still be higher. The total expense ratio of the S&P 500 ETFs is between 0.03% to 0.15% per annum. But we know that ratios, even when small, eat into long-term gains. If, as a beginner, you take the time to research and buy individual stocks, then you can save yourself from these fees. Commission-free trading might make it easier for you to manage your own diversified portfolio without relying on ETF. If you're struggling to start, then it would be better to talk to a financial advisor. There are several digital assistants that may help you for a low to no cost. People often hesitate to seek help, but that only ruins their investing strategies. So, it's better to seek help while you have time, because once you enter into the market, you can't afford high losses. Well, did you know this before? One should always take a step back if something limits your growth. If you found this eye-opening, make sure to like and subscribe to our channel so that you can stay in the loop and never miss out on any of our videos. Subscribe now! Got any questions? Drop it in the comments. We would love to hear your thoughts. See you in the next video.